Today we're talking part 2 of our 28 risks to retirees, and we left off on number 14, so we're going to tackle the second half here and start with number 15.
I'm ready for number 15.
All right, and it's tax risk, and it's basically, what happens if they eliminate certain tax benefits, or if perhaps maybe the tax brackets increase. So,
Let's take an informal survey here, Eric. How many people think taxes are going to be going up in the future? How many people think taxes are going to be going down in the future?
Okay, so there is some
Okay.
tax risk out there too, as far as, especially when you've got things like IRAs, which are not being
Right.
taxed now, they're going to be
Right.
taxed when they come out on the other side.
Right. Well, we've got Roths, which offer a great tax benefit,
Yes,
and there's always the possibility that that could be taken away.
right. And that was with our public policy risk from last week. And if you don't know what we're talking about, I encourage you to check out last week's video.
And life insurance, that's another one
Yep, they're
that has
tax-free,
a lot of great tax advantages.
tax deferral and
Right.
accumulation.
Annuities. So as we
Right.
face all of these possibilities, one thing that we've told our clients, because they've asked us the same question, well, if I go ahead and go forward with this plan, what assurances do I have that the government won't change the rules and disallow this for me? Well, there are no assurances. But one thing that we have been able to, say with some confidence is that in the past, the government has grandfathered those that acted in good faith and were using a viable strategy that was allowed by the IRS.
Yeah.
But the new folks trying to get into that strategy.
Right, it goes away usually. At this.
Right.
So, I guess what we're saying is, on tax risk, don't wait for the rules to be changed, because then it is too late.
Exactly.
So,
Exactly.
interesting. The next one here, we had a little too much fun probably with it. Loss of spouse risk.
Yes.
Now,
Now, what can annuity do to replace your spouse, Eric?
well, in this case, replace the spouse.
I don't think that's what they're talking about.
It's not go out and get yourself a new one.
No.
But it's the financial.
Right. Right.
Each spouse brings a financial benefit, hopefully, to the
Right.
arrangement. And what happens when one is gone?
It makes a big difference.
Yes.
And many times it's not factored in properly. And usually there will be one spouse that will be in a better position if they lost the other spouse, financially.
Yeah.
Than the other spouse would be, because it will create a great hardship. So you got to determine which one is maybe the greatest vulnerability in the planning.
Yeah, and the pension factors, Social Security impacts.
Yes.
What happens, and you hate to sit there and do the math on it, but you have to know
You do.
what the impact is going to be if one of them is not, one
Right.
spouse is gone.
Right.
And how it's going to impact not just, the financial aspect, but
Right.
then there's also replacing usually some of the service aspects and things that they do around
Yes.
the house. I mean, little things
Yep.
go a long way here. So,
Yep. Number 17.
unexpected financial responsibility risk.
Where something blindsides you.
Yes.
And you're like caught unaware
Yeah.
with a huge bill.
Yeah, well, and I always think of, the kid that's going to move back home with me,
Right.
or the
Right.
parent that's going to move back in with you.
Right.
These things,
Or the child or grandchild that had an unexpected health need that wasn't going to be covered by insurance.
right? Yeah. What happens when the unexpected happens?
Right. And
So-
you need to get your hands on that money.
Right.
And you need to spend some of it.
So it's having that bundle, so to
Yes.
speak, of dollars available for that unanticipated need.
Right. Right.
So,
And in some ways that isn't a job for an annuity. So you really have to think in terms of an annuity. How can I position this money and leave it alone so that I've got additional money for those unexpected things that may happen?
right. It's having that resource though.
Right.
That pile.
Right.
So then we have liquidity risk. So, and by liquidity risk, we mean having basically cash on hand. It's
Right.
that ability to go get and take and walk
Right,
away.
which goes back to what we were saying. Don't put too much money in any one area without having some liquid money. Another good example of that area could be stock.
Right. Stocks. It's even annuities.
Sure.
If you over obligate too many of your dollars into resources where
Right.
if you're going to have to go get them out
Right.
and take a penalty for having to go get them,
Right. What happens if the markets fall?
well, you're buying high and selling low, which so you
can't
reduced your principal.
So you don't have the liquidity,
Right.
Unless you want to shoot yourself in the foot.
Right. And the same thing, if you've spent too much on a CD or an annuity, or
Right.
you have to go in and get it out early and there's a surrender or a penalty, those things can impact you negatively
Yeah.
as well.
Yeah.
So it's having the right amount of liquidity in place and the flexibility in your plan to be able to go get those assets.
Right. Another risk concern that doesn't really affect everyone, but we do have clients that it is important to, and that is their legacy.
Yes.
They want to leave something behind.
Charitable giving, I see hospital wings with people's names on it.
A scholarship, some type of a benefit that they want to.
They want to leave money
their
for
memory. Right.
this,
Right.
Well, what happens if what you think you're going to leave is depleted by either poor market returns,
Right.
living too long?
Right.
I mean, all sorts of these
Sure.
other things. So it's
Sure.
how is your legacy going to be impacted
Right.
by?
Yeah, and if it's important to you, then you have to
Have a plan
consider how you're going to make that real.
Yes. So the number 20 here is very interesting. Financial elder abuse risk.
Yes.
Now we were talking a little bit about kind of little known laws that require children to provide for
Yes. Yes, and in many of the states, and I was just reading this recently, and maybe we can do a little bit more of a expose on it, in future videos, but that a lot of the states have laws on the books that actually require the children to take care of the financial responsibilities of the parents that the parents cannot handle. So a few of the states have tested this a little bit, and some children have been called into play and even may potentially face criminal activities for not supporting their parents' needs. When the parents thought that maybe their poor planning or poor decisions would not affect the children.
Right. And then it goes back to more, I would say, the more common aspect where the children don't make good decisions, or they have a financial advisor that takes advantage.
Right.
Things that happen along the lines to basically deplete the resources, thus abusing the parent-child relationship, and
Right.
financially abusing
Right.
it. So.
Number 21 in the time period that we're in,
Yes.
with employment numbers the way they are,
Right.
for retirees, they do face the challenge if they would lose a job, a part-time job, a full-time job, maybe with supplementing their income. Will they be able to get reemployed?
Right. We joked somewhat, and the Walmart greeters are going to be,
Going to be replaced by security cameras. And
So it's the jobs that you think you are qualified for as a retiree. Sometimes you're overqualified. It's tougher to find those jobs, and a lot of people didn't really anticipate having to go back to work, and things have changed. So
Right.
that reemployment risk, or needing to be reemployed,
Right.
even.
It can be serious if you're relying on it.
Yeah. Number 22 is home maintenance risk, which, if you're a homeowner, you know what it takes to maintain it right
Right.
now. Well, as your
As you
your
age.
resources are depleting, and
Right.
all of a
Right.
sudden you think your house is paid for.
Yes.
And everybody talks about, well, my house will be paid for by then. But will it need a new roof? Will it need a new furnace?
Right. And another area of vulnerability on this, Eric, that a lot of times folks don't look at is reverse mortgages.
Right.
A lot of folks say, well, I'll get a reverse mortgage, it'll take care of me, give me that
income
equity
coming
out of my home. But then you still have to maintain that home. If you cannot maintain that home, then you could be in default on the loan.
Sure. If it goes into a state of disrepair, and the other aspect of even being elderly is being able to maintain. If you're physically not able to do the chores that the lawn mowing, the upkeep, those things come to play because you have to hire those
Right.
things out a lot of the time.
Right.
So.
Right. Well, timing risk. That's another thing in terms of what catastrophic things that might happen?
Yeah, I think it's the actual events that impact all of us financially, and some of them are unpredictable.
Right.
A tsunami that wipes out the entire town. An earthquake,
Tornadoes.
They can take away your business. They could take away your home.
Are you properly insured? This type of thing.
Exactly.
Right.
And it's things that you can control and things that you can't control.
Right.
What's going on in
Right.
Europe right now is an actual event that's happening.
Yes.
That's impacting our ability to, earn and save because
Right.
of a financial crisis
Right.
that wasn't of
It
our
all gets
doing.
down to some point in time that we have no control over.
Right.
And so if timing is in our favor, it goes very well, and if timing's not,
Right.
and we can't afford that in retirement.
Right. It's just the times we live in, basically.
Right.
It's,
Right.
can't change the time, huh? So, all right. What about number 24 here? High debt service risk.
Well, I think that most retirees want to say they've got their home paid off, they own their cars, they've got some money in the bank. And obviously we're very fortunate, with ourselves, but also a lot of the clients that we work with that have got themselves in a very good position financially. But we do talk with some folks occasionally that will have some pretty sizable debt going into retirement.
Oh, yeah.
And this can turn around and bite you, especially if you get a variable rate mortgage or something of that nature.
Well, yeah. Variable rate mortgages. Buying that new house right before retirement sounds, it's beautiful, it's what you always dreamed for, but it comes with a new price tag.
Right.
I always talk to a lot of clients, especially in their 40s, about spending money on college. Well, those
Yes.
college loans, they let you defer. Well, all of a sudden, your son or daughter, who's the doctor now, and 12
Right.
years of accumulated
Right.
college loans
Right.
that you're on the
Right.
hook for, and you can pay them off over the next 20 years.
Yeah.
Well, you're in retirement now, and you're paying off your kids' college loans still. How much have you put of your retirement dollars
Right.
into paying off those pieces?
Exactly. You've lost the time value of the money, earning and
compounding,
growing. Exactly. So I do think that when we look at the high debt situation, that we do have to also recognize that there are ways that you could have debt and yet have the money set aside to service that debt,
Sure.
to pay that debt off in full, and you could be earning some arbitrage, making some money
Yes.
on your money. And so there are ways to do that effectively. We don't want to just say that everything has to be paid off. There's smart ways to be in debt.
Yeah, there's strategies if you don't
Yeah.
do
Yes.
number 25, which is procrastination.
There you go.
risk.
I like that.
You
Great
know,
segue.
Yeah, we planned that very carefully. So, but we hear this all the time.
We do.
The rates are too low. The rates are gonna improve. I'm gonna wait till
I can think
next
of
year.
dozens of examples dating back to 2008, 2009. I'm just not going to do anything.
Right.
I'm going to wait. Well, how well does that work for you?
Yeah. What's the impact of your retirement
right.
on waiting?
Right.
Starting too late. We always talk about, if you're going to save for retirement, if you put the same amount of money in between the ages of 20 to 28 and then stop, is the same as putting it in from the ages of 28 to almost age 60. So it's
Yes.
just because of the compounding out there in
Right.
the aspects.
Right.
In my math's probably off slightly there, but it's truly what you're putting
Right.
putting away.
It's
what it costs us to
what
wait.
you can put away and how long you can let it grow and compound. So procrastination is probably the greatest enemy to achieving your objectives in retirement.
Yeah.
Even though you might think, well, I've only got 5 years or 10 years, there's some wonderful things that can be done, and annuities can accomplish a lot of these things with guarantees.
Right.
So that you know that you're going to have at least a certain reasonable income.
Right. So, all right, 26, retirement savings opportunity risk. So, in simple standard language, it's working for an employer that doesn't have a retirement plan.
Or you just didn't contribute much to it.
Yeah. Well, in this case, I think they're blaming the
Yeah.
It's the employer's fault
Yeah.
because if they were supposed to take care of me and provide for retirement, if you don't,
Things have changed.
Yeah.
haven't they?
if you don't take the onus on yourself,
Right.
that really does impact.
Yeah. If you
what's
haven't saved enough, it doesn't really matter whether it's the employer's fault or your fault. you haven't saved enough.
And I think what we're seeing is a generational change from that defined benefit plan where you worked for an employer,
Right.
and their part of their obligation is
Right.
they were going to give you a
Right.
retirement that took care of you for as long as you would live.
Right.
That was going to be your benefit
Yeah.
for working there for so long.
Yeah.
Now we've got these 401k programs that are really more an individual's responsibility.
Which really ties us into 27, which is the
Exactly.
same thing, inadequate resource risk. You just don't have enough.
Well, and this is the speech we have with 401k participants.
Right.
Because
Well,
their thoughts, I'll put in the minimum and the employer
Sure.
will put in this much
Right.
and I'll
Right.
be fine for
Right.
retirement.
Right.
Until they start running numbers.
Yeah, exactly. And there is no silver bullet. If you don't have enough money set aside, you're just limited in what you can produce for income.
Well, you're going to have to step down your living,
Right.
your ability,
Your
your standard of
expectation.
living is going to go
Right.
because
Right.
you haven't put away enough resources.
Right.
And it's tougher to do later in life. So that's that procrastination thing.
Well, and this is a good place, I think, to wind things up.
That's
We're
right.
on number 28, and that's having unrealistic expectations of retirement
Right.
and what it's going to produce, what the results of that retirement are going to be based on what you've saved.
Yeah.
The old saying, we have champagne tastes and beer pocketbooks. So that's a job that an advisor has to help the client a lot of times understand.
Well, and it's hopefully what we're doing here with these videos,
Right.
talking about, we're making you aware, we're trying to educate
Right.
and present the scenarios here, but you have to take responsibility for going out there and answering some of these questions. You're now aware, you've been educated, you've been asked, but you have to make the right decisions going forward. You may not have saved enough to maintain your lifestyle. You're going to have to make changes.
Right. You're going to have to cut back a little bit.
Your expectation was here. Well, reality is here, and you don't have any time left to make it up.
Or maybe you saved a much larger amount of money than you really need. And you have discretionary income, and you can have some money in the market. If you lost it, it wouldn't be the end of the world.
Right.
On the other hand, you're in a very good position financially, and you need someone to help you understand how to spend your money.
Right. And if all of this is overwhelming to you and you don't know which way to go, that's the time to sit down with an advisor.
Right.
Get somebody that can ask you these questions if you're not sure, how to answer them, or at least
Right. We've
present you with the scenarios of things.
And
you have
we've
to
spent
consider.
30 minutes doing these 2 videos probably, and realistically, this would comprise hours and hours and hours of planning with most clients.
Yes. So we encourage you to sit down, take the time, start working through these if you haven't already done so.
Right.
Hopefully you're working with an advisor that is asking you these questions and setting
Yes.
the scenarios for you so that you can be prepared. Our goal is for everybody to have a safe, secure, comfortable retirement. So these are some of the risks that we hope you can avoid and basically have abilities to deal with.
Absolutely. Well, thank you so much for spending your time looking at these different risks that retirees face. They'll be on the website, so you can check them out and read about them and take them to your advisor and do some serious good planning.